long-term investing is sort of like you're on a cruise ship. It's a very big ship and it doesn't steer with a lot of handling. So you're going to go very slowly. You're going to get to point A. Okay.
Welcome to The Important Part, a podcast about achieving financial independence by making smart investments in yourself and your portfolio. I'm Liz Thomas, your host and head of investment strategy at SoFi.
This podcast is sponsored by SoFi to help you get your money right. And it's for informational purposes only. Nothing in this program is a recommendation from SoFi. You should not rely on this program for financial, legal, or tax advice or recommendations. The views expressed do not necessarily reflect the institutional views of SoFi or its affiliates.
Today in studio, I'm so excited to have my colleague Mario Ismailanji join me to talk about his career in finance, talk about what it looks like to work with an investment strategy team, talk about our relationship, and everybody listening should know that he is the analytic rigor and muscle behind all of what we do. I don't know what I would do without him. So welcome to the show.
Thanks for having me. I'm pumped.
Yeah, I mean, I am too. And we've been working together now for over 4 years, which it feels sometimes like 4 minutes, but 4 years we've been at SoFi together. It's gone by so quickly. But at the same time, I remember when we first started, and things have changed so much since that day. It was starting a function. I mean, we launched the investment strategy function at this company and kind of looked at each other like, well, what should we do next? What's the next thing that we can release? What's the next thing that our members want and people want to hear about from an investment strategy team? So it's been so great to just build this with you. And I think this episode will be hopefully really useful for a younger generation. Let's start with how you got into finance. So you came to SoFi, like I mentioned, a little over 4 years ago. What brought you to the financial services industry? Did you always plan it this way?
So definitely not. I definitely did not plan to go into finance from the beginning. I mean, for context, I didn't know I wanted to go into finance, I think, until well after I graduated college. So it was a situation where it was just like, my parents tell me, be a doctor, be a dentist. Well, I finished high school. I go into college. I'm like, what do you major in? You want to be a lawyer? I mean, everyone takes the LSAT if you want to be a lawyer. So at that point, it's like, well, I don't know, political science maybe. So literally Google, what's the best scoring majors on the LSATs? And I'm like, economics, philosophy. I'm like, that's kind of interesting. Physics, get that out of here. And so I literally decided to major in economics and philosophy. And right away I was like, law is not for me. I like numbers too much. This is all too interesting. And economics was a bit interesting. But, at this point, it's like late in college. I don't really know if I want to necessarily just do economics. I'm like, finance kind of sounds cool, but I still don't know. So I graduate. I get a job doing economic and industry research. And literally like 3 months after I started, I'm like, I don't know if this is for me long term. So, I'm laying in bed one night. It wasn't called this then, but, basically brain rotting, just looking up like videos on YouTube. And I'm like, oh, CFA. Like I remember reading that or seeing that somewhere. So I'm looking at the CFA and I'm telling myself, should I do this? And the way it was structured was always there's early bird, regular registration, late registration. And I had just missed the early bird by a week or two.
Okay.
But there was a tech outage or something on the website. And so they extended it. And they extended it to the day I was looking at it. So I was like, this is a sign. And I registered impulsively right there, right? I was just like, I'm going to do this. And I think during the process of, looking it up, I'm like, this is kind of really cool. I'm doing economics at work. I'm learning the finance. And I'm like, I want to incorporate both of these. And, as you know, the CFA is a long process.
Just so everybody knows, CFA stands for Chartered Financial Analyst. It's a designation that you can get. We'll dig into what the program looks like later, and I'll tell people about my battle scars from it. But carry on.
So at this point, I got it, and I was like, well, what am I going to do? And, I had a conversation with another person in the industry at the time, and they were just like, you need to figure out more specifically what you want to do, because at this point I was like, I want to do finance, and I wasn't really targeted.
And how old are you at this point?
So at this point, this was 2021, so I was just turning 26.
Okay.
So And at this point, believe it or not, I mean, look, we started working together mid-2021. So this is early 2021. And so investment strategy, I look it up and I'm like, oh, this sounds really cool. This is exactly what I want to do. So at this point, back to the Googling. I Google, investment strategy jobs, New York City.
Okay.
Because I'm like, I'm not moving elsewhere. I'm like, New York City's, my heart is here. And, like one of the top results was literally the investment strategy position that you were hiring for at the time. And, cold applied, sent it into the black hole of online applications. I mean, it was a pretty quick process after that. And, started working together in August of 2021. And 4 years later, here we are.
Yeah. Okay, let's rewind a minute, though. So, because that was when you were 26, which means that there was, let's call it roughly 4-ish years post-college.
Yeah.
So you came out of college with a philosophy and economics degree.
Yeah. Weird combo.
Let's talk. Well, but maybe not for people listening. I think that there are a lot of people that you have to decide on your major when you're so young.
Yeah.
And I've always thought it was just such a backward system that we're trying to force 18 and 19-year-olds to figure out what they want to do for the rest of their lives before they really even know what they're good at. But you have to choose something. So you chose philosophy and economics. Do you think, and this is for the people out there that are majoring in something, or maybe they have a degree in something and they're looking at it like, why in the world did I do that, right? Or I wish I would have known something else before I chose that. But do you think that philosophy has helped you in this career?
So much.
Okay,
and I mean, it might not seem obvious because a lot of people think philosophy, they say, oh, what do you do? Just sit on rocks and think all day or something like that. And just while I do that in my spare time, like I think a lot of what philosophy is you're digging into really dry topics and you're thinking critically about stuff. You think about philosophy, you think about, thorny issues, morality, aesthetics, existentialism, all these really wonky, crazy, really deep topics. And the big thing that ties it all together is literally you have to think. And you have to think very deeply and, thoughtfully about what's going on to try to get to a situation where you can, have a takeaway. And I think in finance, a common adage is that, the stock market prices in all information, right? And even then, it doesn't mean that the price isn't going to go up or down. You have investors on both sides of the aisle always saying, I'm bullish, I'm bearish, and everyone's competing with a viewpoint. In some ways, philosophy is like that because all the stuff that, was easy to solve was already solved. The issues that are left are, really complicated. And sort of like when you're thinking about the economy, markets, which way should interest rates go, it's all very complicated. And so I think it really teaches you to think critically, criticize and investigate your biases. How can I be wrong? I mean, that's a big point of emphasis. And I think that, I bring that with me every day for sure.
Well, and I think there's a big element of what we do that you have to make decisions and you have to draw conclusions with just as much information as you have, which isn't ever going to be all of the information. And you're never completely sure. And I would argue there's really no way to even know if you're right or wrong until after the fact. Yeah. So there's no such thing as it just being math where there's an equation and on the other side of the equal sign, it's like, that's the right answer. That's not how this works. It's very mushy in a lot of ways. And you have to use what we call the mosaic theory, take all the relevant information that you have and somehow put it together into a coherent thought process and then say, okay, based on all of this information, which is not the complete set of information because you just can't possibly get all of that, here's what I think. And I would imagine critical thinking skills help in that regard. So let's then talk about the CFA and just even philosophically, let's talk about the CFA because I finished in 2015 and it was a grueling number. I took this exam when you could only do it once a year. There are 3 levels to this. Okay. You do level 1, 2, and 3, and then you are a charter holder. You become a charter holder. You could only do it once a year when I did it. And I am here to tell everybody it is not easy. Do not underestimate the CFA, and especially certain levels. I think there are levels that people struggle with more than others. I struggled a lot with level 2, so it took me forever to finish. And when I finally finished, the sense of accomplishment and everything that I had was so big. I don't know that I've felt something like that since. It was just such a grueling process. But I say all that because back in that time, it was very well respected, if not almost necessary, to be a CFA charter holder in order to do and get some of these jobs. I don't know that that's the case anymore. I think some of the luster has come off of that designation. You got yours long after I did mine. Talk about, or sort of, did it change? Like, do you think it's changed, and has it changed even since you finished?
Well, it's definitely changed since I finished, that's for sure. I mean, I would say even when I started, I think it was like midway through the process of it mattering or being seen as less prestigious, if you want to call it that. And I think a lot of it, I mean, you can map this out to a lot of different parts of investing or really even the world where like expertise is somehow more like people doubt or are more skeptical. I mean, especially now when you look at the way people invest, so much of it is momentum based. It's about the story, it's about the vibes, it's less about the fundamentals, you know, air quotes on that.
Sure.
And so it just, now it's like, oh wow, the CFE, that's such an old school like fundamental valuation. Yeah, right, exactly. Like, oh wow, you're actually looking at the three financial statements and trying to balance everything. That's not really how we invest. We invest because whatever someone endorsed. Yeah.
Let's help the listener understand what investment strategy is, because if you go into finance, there are so many different avenues you could take. Just countless different ways to take it. But let's talk through just investment strategy as a function. I'm sure you get this too. People ask for investment tips. It's like, what stock should I buy? What's going to happen with X, Y, and Z that I heard about at a party last week, right? And that's not really what we do. We certainly don't say, here's the stocks that you should buy. But let's talk about what it is that we focus on. You mentioned before something about fundamentals. Just for everybody listening, fundamentals are things that are usually measurable parts of whether it's a stock index or a specific company itself, things like earnings, things that you can point to and say, okay, here's what I think the fair value of this company is, or the fundamentals of the economy, which you and I talk about a lot. So things like GDP growth and inflation and the trajectory of rates and looking at markets broadly, what's happening with yields. There are a lot of different things that we could throw into that fundamentals bucket that I think people usually regard as boring, or maybe even a younger generation would regard as boring analysis. I know we don't think it's boring, but I still think it's absolutely necessary. And some of it has become a little bit of a lost art because of the other part that you referenced. Everything's very short-termy right now. And I think some of that will come and go. But right now it feels very short-termy and momentum-based. And everybody just wants to buy things because of the feelings and not so much because of the price or because of what the numbers actually say. So when we focus on fundamentals, talk about the tools, the toolbox, I guess, that you would use to put into an investment strategy conclusion, for example.
I mean, a lot of it ends up being like, well, one, what is the market saying right now? So if, for example, there's I don't know, let's say inflation's really hot or something, hypothetically, you would want to see, okay, well, is the market behaving as if that's the case? So like if you saw inflation be really hot or really cold, but the market's doing the opposite of what you think it should, that tells you, okay, well, what is it saying? Fine, maybe the fundamentals right now are that, but is this the market saying that it expects it to change in the future? So I think a lot of it is have an understanding of what's the current backdrop, try to have an understanding of what is the market saying it expects the backdrop to be. And then it's, okay, well, now that I know that this is what it is and this is what the market expects it to be, do I agree? Do I think that that's actually, I mean, I don't want to say do I think it's reality, but do I think that that is, a reasonable set of opinions or beliefs to have? And then you can look at it and say, okay, well, like you could look at economic data, you could look at what companies are saying in terms of their results, in terms of their guidance. And like you had mentioned mosaic theory, there's not going to be any one answer like, yes, like the market is right. You're going to have to piece a lot of different pieces of information. And then you put that all together and you say, okay, well, I think, like there's, my vibe is it's 80% correct, but I think the market's a little wrong. And here's where I think it's wrong. And then you say, okay, well, if the market's a little bit wrong and that's what I think, you think that, well, because of that, I believe stocks are a little bit more attractive or a little less attractive. I think bonds are a little less attractive or more attractive, and so on. You piece together a total view on where you believe things are relative to the market. And at that point, just time will tell whether you're right or where the market's right.
Yeah. And it's also worth mentioning, there's a school of thought that the market's never wrong. And there's a lot of people out there who would say, well, the market is telling us the direction of fundamentals right now. It's predicting those, or it's looking through some of the information that you might be paying attention to because it's not important. And you just have to take the signals from the market as your inputs, and that's what you react to. A lot of that is talking about technical analysis, which we don't do a ton of. We do some of it as signals. But let's look at it as more of a long-term investing idea. So we've got signals from the market on a daily basis. Right. We've got information from the economy on a weekly, sometimes daily basis. But we shouldn't change our portfolio based on just one or two inputs. So I think one of the important things to always be reminding, especially our audience of, is you have investment goals, and those goals are usually longer term. Maybe it's that you want to buy your first house. Maybe it's that you have a young child and you want to put that child through college without any debt. Maybe you want a new car. Whatever your goals are, usually getting to those takes a while. So the process and part of our job is helping people get to those goals. And that's something that's really important to us at SoFi, is helping people achieve their ambitions, right? Yeah. How would you think about approaching that from an investment perspective to make sure that we don't get sidetracked by all of this stuff that's happening day to day?
I mean, one, it's try to keep your goals front and center, where it's like if you start telling yourself, like, I'm investing a certain amount of money and I'm going to invest it because I want to put my kids through college, I want to retire and be able to fund a lavish lifestyle or whatever it might be, you need to have those goals in mind. Because if you just think about the markets on a day-to-day, a lot of news comes out literally every hour. And if you get sidetracked by that, you can get really overwhelmed. An analogy I like to think about when I talk about investing long-term, and it helps me keep it in mind, even for myself, because look, we're all emotional people in some respect. And so no one's going to be completely immune to all the crazy stuff that could be happening. Mm-hmm. And so my example is always, long-term investing is sort of like you're on a cruise ship. You're not a jet ski going in and out of the waves, going left and right, everywhere up and down, right? Mm-hmm. It's a very big ship. You might have little regions or cities you might visit, but it's a very slow process. It's a very big ship, and it doesn't steer, really with a lot of handling. So you're going to go very slowly. You're going to get to point A. Okay. You're going to get to point B. You're going to have a plan. Okay. You're there for 2 days. You're going to get to point C, and so on and so forth. Mm-hmm. And if you stick with it, you're going to get to all those different, points of emphasis, whether, on a cruise ship, it's whatever place you're visiting. But when it's investing, you're going to get to goal A, you're going to get to goal B, you're going to get to goal C. And if you end up thinking about those goals and keeping them front and center, you might tell yourself, okay, well, I might lose 5% because some volatility right now. Mm-hmm. But I know that over the long term, if I keep up with my bi-weekly contributions or whatever, keep up with, not panicking and taking it all out, eventually you'll get to the point you want to get to. Because look, is it possible that maybe the market's going to have a drawdown? For sure. Drawdowns of 15% or more usually happen most years. Mm-hmm. But the problem with that is you might miss a little bit, but if you get it wrong, you can really hamper your long-term journey. And I think a lot of people just think about the number. They think about, I'm trying to maximize my investment gains every year, which of course, everyone wants more, not less. But at the end of the day, if you're achieving those goals that you set out, that's really all that matters.
Mm-hmm. So how do you tune things out when you're sending me information? Because a lot of times I rely on you, I'm pulled in a bunch of different directions, or I might be really busy on a certain day or a certain week. I can't keep up with all the headlines as they're coming in. So you'll send me stuff that you think is important. Hey, make sure that you look at this, or, just an update of, hey, this data came in, want you to know about it. How do you filter out all of the noise so that you're not sending me 65 headlines a day?
I mean, I think it goes back to what we mentioned before about how, there's so much information going on, and you have to ask yourself, how does this affect what the market is saying? Mm-hmm. And if it doesn't affect it, I mean, for the most part, unless it's like a really big report, I'm just going to not even tell you about it, right? Because I'm just like, all right, let's say retail sales come in and it's just completely in line with expectations. Mm-hmm. I'm not going to be like, hey, completely in line with expectations, nothing has happened. Check this out right now.
Market doesn't care.
Yeah, exactly. Yeah. But if it's something like, hey, you know what? Like, I was expecting this, the market was expecting this, and we got something really different. Here's what could be happening here. And a lot of it ends up being, it's about adapting and updating your views as to how things might change. And I mean, like you said, you're getting pulled in a lot of different directions. And so part of my thought process might be, if this has really changed things, I'll let you know right away. If it's something that changes it a little bit, I might look at it and say, okay, well, data point A, B, and C all changed a little bit, but together they paint a certain story. And so I'll try to, extract the story out of every data point to try to present to you the actual story itself that I think is kind of relevant. And then, if you end up following up with me and you're like, oh, well, I don't know necessarily if I agree with you, or that's interesting, but then how does that affect ABC, whatever. And then I'll be like, all right, well, let's go back to the data pipeline, and I'll go check out how the story might be changing based on what you tell me. So sometimes it is a bit of an iterative, feedback process between you and I, but it really does end up being like, find out what's completely pointless data, and then find out what might be sort of important, and then we go back and forth.
And I think that's an important point to bring up. Seeking out other viewpoints, especially ones that contradict your own or that can look at things in a different way. There are ways that you might look at some data that I would have never thought of, right? And vice versa. I might be looking at it through a lens of something that I remember from my career 15 years ago that you would have never thought of. And I can think back and say, well, wait a minute, I remember when this happened back in 2006, and how that felt. Let's be careful of this. So I think that piece of it, that sort of back and forth, and it's not necessarily that we're arguing about things. It's just different viewpoints and then trying to come to the best conclusion that we can about it. One of the things that I think is important to mention too is, in the last few years, when we talk about, short-term, long-term stuff, in the last few years, or maybe since COVID, meme stocks have been a topic that sometimes they're hot, sometimes they're not. We might go months without really talking about meme stocks, and then all of a sudden they heat back up and they're here again. And there's some level of dopamine that comes from all of that, and investors searching for the next one that's going to be up, 200% in a very short period of time. But back to your analogy about a cruise ship, meme stocks are not the thing that are going to help you steer your cruise ship to its next destination. Meme stocks, I would suggest, are things that are going to be waves that come along and maybe move the ship a little bit, but they're certainly not changing the direction of your life unless you got lucky and hit it big on one of them and sold it at the right time, but then paid a bunch of taxes on it.
Or unlucky, I guess you could say.
Exactly. You could also be on the complete opposite side of that and get totally unlucky and have missed it when it turned back around. So talk to some younger investors about not getting sucked into that dopamine hit.
I think it's so hard, because I think sometimes getting sucked in by that dopamine aspect to it can be really educational. If you were the type of person that never invested and you see a bunch of meme stocks going up in price and you're like, I want to get in on this. If you get in, and then maybe that kickstarts your investing journey, and maybe that gets you really, really interested in investing, and it gets you more engaged, and you take a more empowered, active role in your finances. That could be really awesome. But the downside is, when you get away from, like we said before, the fundamentals, meme stocks are not very fundamentally driven. And so it can go up a lot in price, it can go down a lot in price. And I think I'll never tell someone what to do with their money specifically, but what I would say is just keep those goals in mind. Investing in the next meme stock, is that going to get you the new car in 5 years? Is that going to get you to whatever goal you have? Will it actually get you there in a reliable way? Can you reliably tell yourself, hey, I need to get into these meme stocks because that's the only way I'm going to retire? In most cases, that's probably not true.
Yeah. That was a really good point, though. And it was something that when meme stocks started, I used to make this point a lot, because it was when the rise of the retail investor had started to make headlines. And the retail investor today is so powerful. Yep. And obviously at SoFi, we serve retail investors. They're so powerful, and they're so much better informed. There's so much more information at their fingertips than there used to be. And I think that's a wonderful thing. And I think if meme stocks and some of the news that happened around meme stocks is something that got you invested or got you interested in investing, that's great. Now, If it got you interested and you put your whole life savings into one of those meme stocks, that's less great. When you're looking at some of those hot dot investments, and I'd put meme stocks in that category, I would just caution people, make sure that you're doing that kind of thing on the periphery, right? On the edges of your portfolio. So there's the core of your portfolio, and you might have some other things in there. You want to be overweight a certain sector, or you like a certain theme, something like electric vehicles or cybersecurity, whatever the theme might be. If you're buying and kind of playing in that sandbox of individual stocks, particularly ones that are meme-ish, you don't want that to be a huge position, a huge concentrated position in your portfolio. Because the other thing, and this is like people start snoring, I'm going to talk about taxes for a second, but by definition, you've got meme stocks. This happens over a very short-term period. So even if you did hit it big, and it happened over a 6-month period, in order to get your gain, you got to get out of it, which means that's a short-term gain, not a long-term gain. And depending on your tax bracket, short-term gains could be taxed at a higher percentage than long-term gains. So keep that in mind too. You might have made 100% on it, but then you just got taxed on, 35% of it because it was a short-term gain. So there are things that can happen throughout that process that might just take the wind out of your sails very quickly. All right, I want to pivot a little bit to talk about active investing before we finish this up. We've heard a lot over even the last decade, active versus passive, and for the most part, active investing has not done well compared to passive. Passive being basically investing in what's represented by an index, and then active investing being choosing particular sectors or choosing particular stocks, taking an active approach to that same sort of exposure. What does active investing mean to you as, I think, somebody of a younger generation? To me, it means something different than it probably means to you. But how do you look at active investing?
I mean, I think for me, it's like many things, it's on a spectrum where you can get into fully passive where it's just, I'm investing in an index fund, whatever it does, I'm not looking at it, and it is what it is. I'm just going to let it go. Versus, purely active, which is like, hey, I'm going to select every security that I'm investing in based on my opinions and beliefs. And I'm not going to even think about the market weighting. I'm not going to think about what others think about it. I'm just going to invest in it. But I think that's what active and passive is to me. It's about how much of a, pardon the word choice, how much of an active choice are you making to selecting what you want? So if you just were like, you know what, I have a 401k and I just went with whatever my employer told me, all right, you're probably kind of pretty passive. If you start going, well, I'm going to look at this every 2 months and decide if I want to sell or buy, then you're a little bit more active. And it's all differing shades of both.
Yeah. Well, and I think one of the benefits today for investors, particularly individual investors, is back in the day, active investing meant mutual funds or some portfolio of individual stocks, and there was someone making a decision about which stocks to buy and how much of each stock to buy, and that was the active investing that was available, and it was expensive. You had to pay a lot to buy those strategies, and there were minimums, and some of them had gates on them. You couldn't get in unless it was a certain type of account, and all sorts of difficulties in actually being a part of that. Today, we've got more ETFs than we could ever track. There's an ETF for everything. There are ETFs for specific sectors. There are ETFs for certain industry groups. You could actually be an active investor with passive strategies and keep your fees pretty low, which is a lot of what we talk about when we're thinking about investment strategy. So I think it's a huge benefit to individual investors today that we've got all of these ETFs that you can express different views on.
No, 100% I agree. And a lot of it ended up being sort of this ongoing process. I mean, honestly, since kind of like 2020, 2021, meme stocks in a way ushered some of this in, of this democratization of finance, this ability to, not have things, walled off where like, oh, you need a certain account minimum to get into this fund, right? Being able to actually invest in a broad scope of things and be still diversified. I think what makes passive so attractive nowadays, and what made being active before a lot less attractive, was if you were, trying to invest, it was kind of hard to be diversified fully and keep those costs low. You can have targeted exposures and keep the costs relatively low, keep your diversification relatively high, in a way that at the end of the day, you're always going to have a bit of a trade-off when you go passive versus active and the differing levels of each. But as long as you're able to do it in a way that's as good as you can expect it to be, as low fee, as relatively easy, because the easier you make it, it enables a lot of people to actually get started on their investment journey and not fully be like, oh, this is too hard, I'm just not going to do this anymore.
Well, thank you again for being here, for having this conversation. I have definitely enjoyed it. I'm sure our listeners have enjoyed it too. And I would just wrap it up by saying I think the most important part of that whole conversation was about getting into finance, what brought you here, and then why it's still such a fun job, and the curiosity that you have and the desire for learning. And I would send a message to anybody listening who wants to get into finance but either thinks that they don't have the right credentials or they're behind. You are not. You are not behind. You do have the right credentials, because there are people all over this industry with the most bizarre credentials. It doesn't necessarily matter if you majored in sociology. If you want to get into it, you can find other ways to teach yourself, to learn. And again, it is a lifelong learning process. So if you're curious, if you're passionate, if you're interested, I would still encourage people to get into this industry. So thank you for being an example of that. Thank you for everything that you do for me and for SoFi, and for just always with a positive attitude too. So this was great.
Thank you. It was.
For more from me, read my weekly column in SoFi's newsletter, On the Money, and on the SoFi website, or follow me on X at Liz Thomas Strap. Follow The Important Part wherever you get your podcasts. The Important Part is produced by SoFi in partnership with Sony Podcasts.
Investments are not FDIC insured, are not bank guaranteed, and may lose value. SoFi Invest is a trade name used by SoFi Wealth LLC and SoFi Securities, offering investment products and services. Robo-investing and advisory services are provided by SoFi Wealth LLC, an SEC-registered investment advisor. Brokerage and self-directed investing products offered through SoFi Securities LLC, member FINRA SIPC. For disclosures on SoFi Invest platforms, please visit sofi.com/legal. For full listings of the fees associated with SoFi Invest, please visit our fee schedule.